I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with James McDonald and Jeremy Bendach, the portfolio managers of the Pengana High Conviction Equities Fund. The format for today's webinar is going to be a short presentation, which will leave plenty of time for Q&A at the end. So any questions you have about the fund or the economic environment or specific exposures, please enter them into the Q&A box, which can be accessed from the icon on your screen. And hopefully these questions will form the basis of an interesting conversation at the end. James, over to you.
Good morning, everyone. Today, we'd like to do a quick recap of our investment process, then take a quick look at the macro that's out there at the moment and how we're positioned for that, then do a deep dive into 4 of our holdings, followed by Q&A, as Adam mentioned. So to begin with, as I mentioned, we've mentioned in the past, the important factors we're really trying to find in companies is firstly businesses with a strong competitive position. That might be a technology, a high market share, low cost of production, a brand. And secondly, we're trying to buy that business at a significant discount to fair value. I think that's probably the most important part of investing. If the companies are under-researched, out of favour, or have hidden value, we really like that. Those things are not essential, but you do tend to get better returns, in my view, if you find those factors. Cash generation is obviously very important. If you don't have that, you really need to have a very strong balance sheet that can see you through till you are cash positive. Quality of management is very important, of course, and incentive structures that are aligned with the shareholders. So share ownership or stock option packages are preferred. Just turning to the macro and positioning of the fund. As we all know, I think by now, inflation and interest rates have been driving the market, and there's been a very high level of correlation between stocks over the last 6 months. We had a nice surprise a few days ago when the US monthly inflation number came out at 0.3%. So if you annualize that 0.3%, or if that recurs over the rest of the year, inflation should come down from the current 7.7% down to more like, mid 3%. There's obviously debate about how quickly that will happen. There has been plenty of lumpy data in the past, so it's not certain. But of course, the market took a great deal of confidence from that lower monthly inflation number. And you can see in the blue line there on the top right is the Institute of Supply Side Managers survey of services companies' sentiment in the US and how closely that sentiment is tracking inflation. So if inflation comes down, of course, business sentiment should improve as well, which would be good for markets. On the bottom chart there, we thought it was interesting to highlight what the factors are driving the market return. So the black dot in that chart is the market return for the NASDAQ, the S&P, and the ASX, down 28%, 17%, and 4% respectively year to date. And the orange there is the PE derating that's occurred. So the multiple of earnings that shares are trading on. The EPS is in the blue. So earnings haven't really changed that much. They've fallen in the NASDAQ, still up a bit in the S&P, and up quite a bit in Australia, where we've got a high weighting to things like oil and gas, which has been very strong, and other sectors that have been doing reasonably well in Australia. So markets will rebound 6 to 12 months before earnings bottom out in a recession. So we do need to be looking for bargains now, and where we are doing that, we've reduced our cash weighting from about 18% to 12 or 13%. It's a mix of growth and value in the portfolio, but with large upside potential in our view. We've added some new positions in OPTHEA, MEYER, and both of which we'll talk about, KNS, the European potash producer, HCA and Tenet Healthcare in the US hospital companies there. And we've also increased our holding in Howard Hughes, a US property company, and Amadeus travel software stock in Europe. Just turning to some of the holdings in the portfolio, TELIX is the largest holding in the portfolio and has been for the last 4 years. It's about 14% of the fund and was up about 50% over the last 6 weeks. We really like the business. It continues to de-risk its profile. It's got one approved product, and last week we had some very good news on a second product, which I'll go into in a minute. They've got 9 other products under development, so it's a very deep pipeline of products to drive growth in future. We expect rapid revenue growth over the next 3 years as a result of the first 2 products. Last week we had data from its renal cancer diagnostic. That involves attaching a radioactive particle to an antibody that selectively attaches to certain types of cancer in the body, in this case, renal cancer. And they reported very strong efficacy in identifying that cancer in the kidneys. We see about a 500 million potential USD, 500 million market opportunity, with approval beginning early 2024 and no competition really for 4 or 5 years. So very good position to be. This product will really replace renal cancer biopsies, which are the current standard of care, which is where you inject a needle into the kidneys and extract some material to analyze. It's very invasive and can in fact spread cancer. So this is a much preferable way of doing that. There's actually a huge number of renal cancer masses being identified at the moment in CT scans and MRI scans of other parts of the body, brain, hips, knees, etc. So you need to work out what those renal masses are, preferably without having to do invasive surgery. The first product is at the bottom there, the prostate cancer diagnostic Illuccix, that was launched in April and received reimbursement in July. The market size is about 700 million, with TELIX having about 20% of the market and the competitor Lantheus having 70 or 80%. Novartis has also entered the market, but we see the market itself growing strongly over the next couple of years to something like 1.2 to 1.4 billion. And TELIX hopefully will be able to get a third or more of that market. And so the current consensus estimate for 2023 is $210 million US, which seems pretty low. If they can get a third of the market, that would be more like 400 million in revenue USD by 24. Market cap's around 1.4 billion. The competitor Lantheus has a market cap of about 4 billion. And I would argue, TELIX has really got a better product portfolio and certainly a better pipeline than Lantheus. Although, to be fair to Lantheus, they were first to market and do currently have 80%. So to the extent those shares sort of normalize over time, I guess there's hopefully plenty of upside in TELIX. Moving to the next investment is the largest US hospital provider, HCA Healthcare, has about 182 hospitals in the US with 49,000 beds. It's a $59 billion company. Nice free cash flow generation, generating 5.3% of its market cap in cash flow every year, increasing to about 8.5% in 2024. The reason we like this business, though, is COVID really impacted hospital admissions and nursing costs. And the right-hand chart there, you can just see the 10-year average projection of where admissions should be in the red line, and in the blue line, it's where admissions actually have come out. So we think there's a nice catch-up in admissions. Temporary nursing care costs really exploded because of the COVID impact on nurses, shortage of nurses, and we think that will normalise as well, which will be a nice catch-up in margins. Turning now just looking at that business has really benefited by paying down its debt. On the left-hand side, you can see it, debt to EBITDA fell from 4.5 times. That's debt to cash flow ratio, 4.5 times down to approximately 3 times. And on the left-hand side, they also bought back a lot of shares using the cash flow in the blue line, which greatly benefited the share price with an approximately 10-fold increase in the share price over 10 years. It did pull back substantially in 2022 due to COVID, which is where we've entered the stock. OPTHEA is another new name we've added in September. This company's developed a drug for a disease called wet age macular degeneration, which is the leading cause of irreversible blindness in particularly elderly people. There's 1.6 million patients in the US in total, with about 200,000 new cases every year, and about 4.2 million globally. It's a large potential market of about 10 billion and growing. So the company conducted a non-dilutive financing in August and September, primarily from Carlyle. They did raise some capital as well, but Carlyle, the private equity fund, actually acquired a specialist biotech company called Abingworth Fund Manager, and Abingworth did the due diligence on OPTHEA, which I think is a great vote of confidence in the company. The market cap is $270 million US. They have 150 million US of cash, with another 70 million due from Carlyle over the next 13 months, which enables them to conduct 2 very large global phase 3 studies for their drug, which should report in mid-24. It has fast track approval, so by 25, should be on the market. And we think it could be a $2 to $4 billion US drug. So if that's the case, this won't be a $300 million company. It would be, 5 to 10 billion, and could well be a takeout target in that time. I mean, Roche and Regeneron are the 2 market leaders in that market. And this would be a valuable asset. It works, interestingly, very well in conjunction with all the existing wet AMD drugs, and is used as a combination therapy. We are a bit surprised that the share price hasn't responded better to having this financing in place, which leaves it in a very strong position. So we look forward to getting some more updates from the company. The first, in fact, is this afternoon at 6:30 at Jefferies conference in London. It was the first update they've given since the financing. Jeremy, over to you on MEYER.
MEYER is a solar panel manufacturer based in Europe. We've had a reasonably long history of association with this company. It has been in the portfolio before. And the reason that we like the company is it's entering a phase now where it's pivoted its business away from supplying machinery to make solar panels to actually manufacturing their own in-house panels using their own technology, which is very competitive. Now, the way that they have grown their sales channels means that they have really good opportunities both in Germany and the USA to build out production facilities to facilitate their European and United States expansions. And they've recently signed a very large contract with a US company to enable that. Now, strategically, we think this is a very valuable company because the Chinese solar panel manufacturing industry currently dominates global supply of solar panels. And post the invasion of the Ukraine and increasing tensions in the South China Seas, where both the US and Europe are very concerned about how they will obtain a supply of solar panels to facilitate their green energy transition. So they are looking for alternatives, and they've been very supportive of these types of companies. As the business scales, and you can see on that chart on the right-hand side, they're growing from nameplate capacity of 1 gigawatt of production in 2022 to 3 gigawatts by 2024. And as sales come through, the business, we believe, will be very scalable and will grow its margins and earn quite a reasonable rate of return. So as I mentioned before, it's a nice sweet spot because of that strategic global value that this company has. It's pretty much the only major supplier of solar panels in the Western world that has the ability to scale, and we're in a nice spot with the green energy transition requiring these types of panels. Thanks, Jim.
With that, I think we will open it up for question and answers.
Thank you, gents. We have received a few questions, and I'm going to kick off with those, but if there are any more, please, now is your time to ask. First question. The strategy has obviously struggled this year. Is that related to inflation and interest rates, or are there other factors at play?
Look, certainly inflation and interest rates has impacted areas like biotech. I think the biotech index is down 33% over 1 year, and we do have quite a lot of healthcare holdings, about 40% of the fund in that sort of small space. But in addition, I guess like all fund managers, we've had some stock-specific issues and some winners as well.
Cool, thank you. And on a regional basis, are you seeing pockets of value? Are there areas that you think are particularly interesting?
Yeah, I just spent a couple of weeks in Europe where, met a lot of companies where, European markets have been very beaten down over energy and Ukraine. Spent some time with our largest investment in Europe, a company called Eckert & Ziegler that makes isotopes for radiation therapy products, which we identified as part of our due diligence on TELIX. And that company's doing very well. There's a whole wave of radiation therapy products that are going to hit the market over the next, 4 or 5 years. And that company's broadly supplying across a lot of those trials. So over time, that will build a very nice business for it. And a few other companies, Amadeus, we've traded that a little bit, but it's the world's largest travel software company that also does software for hotel bookings. Its two competitors, Sabre and Travelport, both have a lot of debt, really struggling. Travelport was taken over by private equity just before the COVID hit. And Sabre also was a private equity relisting with a lot of debt. So Amadeus is very well positioned to take market share. And we think going into 23 that a lot of the disruption that occurred to airlines from staff shortages and plane shortages in 22 will ease up in 23. And historically in recessions, passenger volume has fallen around 3%. So there'll be some positives and negatives, but we think that company will continue to do very well. And we also added a few other names, K&S I mentioned before, in the potash market. Generally, I'd say Europe is actually benefiting a bit, is benefiting from this warmer period of weather that's expected to last for the next couple of weeks. So the natural gas price in Europe has really plunged back to levels sort of before the Ukraine invasion. Europe only has 2 months of gas supply, so there is a risk that we get a really sharp cold snap and then they're back into a bad position in February or March. But they are building a lot of LNG terminals very quickly. So that will somewhat offset that, but we do need to monitor, the weather, and then going into 23, they're going to be short a full year of Russian gas. This year the Russians were supplying gas to Europe up until May. Next year that's not going to occur. So, there is a little bit of uncertainty, but I feel like that the LNG terminals do look like they're all coming online, and there's a huge number of gas tankers waiting off the coast of Europe to deliver gas, which is encouraging. So, yeah.
Okay, that was a very comprehensive answer. Jeremy, I think this is probably a good question to address to you. We've seen quite a lot of legislation passed in the US, which could provide tailwinds to investors in certain sectors. And it feels like companies like MEYER will benefit from the Inflation Reduction Act. Have you got other companies in similar situations, and have you particularly tried to position to take advantage of these tailwinds?
I think you mentioned MEYER, and specifically we've positioned in that company, and as you mentioned, the Inflation Reduction Act is quite beneficial to them. They receive a tax credit per gigawatt or watt of production that they make, which is effectively a subsidy and lowers the cost of production in the United States. We're also looking at other types of businesses in this space, but our primary focus so far and a stock where we felt that tax benefit wasn't properly being reflected in its valuation was MEYER.
Okay, great, thank you. Next question, is the bounce in Howard Hughes a result of being oversold, or does it reflect specific business conditions?
I think a bit of a combination of both. Bill Ackman, the chairman, is also put in a tender offer to buy the shares. Actually, it's below the current share price. It's currently 66, and the tender offer was between 52 and 60. So he's trying to take his stake in the company up to 40%, which I think is a great vote of confidence. The NAV value of the business is substantially higher on an asset backing basis. You can get up to $90 or $100, but obviously the concern is that their business involves two parts: selling land and also operating things like shopping centres and hotels and office towers. People are concerned that the land sales will slow down, but most of their land is in low tax jurisdictions like Texas, Arizona, Nevada, and there's very favourable demographics in those areas as people want to move, and also for the weather. And housing is very, very cheap in many of those states compared to the coastal areas. So I think those demographics will continue to support the land sales, which are made to housing developers. But, with the 30-year fixed mortgage rate going up from 3% to 7%, clearly that's going to slow down house sales. Possibly, though, it will favour people who are selling new houses as opposed to reselling existing houses, where homeowners don't want to break those very attractive mortgage rates and resell. So really, your only option if you want to move to one of those states is to go and buy a house developed by one of Howard Hughes's developers. So I think it's a combination of just a risk. Sorry, long answer, but bit of a risk environment. But Bill Ackman's bid for the stock for some stock would have certainly helped.
Great, thank you. Next question, are travel companies still pandemically disadvantaged?
No, I would say, we're seeing a great rush back to travel. In fact, the main area that hasn't recovered is business travel. But personal travel is really almost fully recovered. And it was really just the shortage of available travel staff, flight crew, the airline sacked so many people in airports in the pandemic that it was just very hard to get back to full capacity. But business travel hasn't fully recovered, and our view was that may never fully recover because of more Teams and Zoom calls. But I think I think people have been pleasantly surprised by how quickly even business travel's recovered.
Right. 40% exposure to healthcare is a significant position. What risks do you see in the sector at the current prices? I mean, obviously, things are now a lot cheaper than they were a few months ago. Current prices, what are the risks, and is there anything that can be done to sort of mitigate them across the portfolio?
The risks tend to be much more stock specific, I guess, in healthcare than overall macro. I guess in this period where you get a risk on rally, possibly healthcare underperforms a bit because people go into more economically sensitive type names. But the fundamental drivers for all of our positions are not particularly correlated. I mentioned TELIX, OPTHEA. Another one is MEYER, a cancer immunotherapy company we've held for some time. And really the risks are delivering on their clinical studies primarily, and then for TELIX, ramping up and executing on its sales growth. The hospitals are probably main risk there I would flag is the shortage of nurses longer term, just globally, not particularly in the Western world. For those two companies, they actually have negotiated with unions already for the next couple of years to lock in pay increases. So we don't see it as a major risk, but it's certainly something that would want to monitor. A major recession, strangely in the US, most people are covered by health insurance, which is through their company. So if you get a major recession and a lot of people are laid off, then people might not have any health insurance and may get less procedures. And oddly, before a recession, you get actually a surge in people wanting to have procedures done because they're worried that they might get laid off. So in the short term, it actually may be a positive, but something we should probably monitor for our hospital holdings.
That's interesting, that difference between the short-term and longer-term impacts.
Yeah.
Next question, are there any themes that you are looking at where you see businesses with a lot of blue sky?
Another one that I should mention alongside HCA is Tenet Healthcare, which is a bit similar to HCA, except half its business is actually related to ambulatory walk-in centres, which are these day surgery centres, which it's much cheaper to have surgery as a day patient rather than stay in a hospital for obvious reasons. So that is a higher growth business. Tenet has got higher debt levels than HCA, still, in our view, reasonable, but probably a slightly more leveraged version of HCA, which, as I described before, as we get that deleveraging over the long term, could be a really powerful driver for the stock. They've locked in all of their debt over the next 10 years, so we don't see a lot of interest rate risk in the business. But if they can just pay off their debt, it'll do extremely well. And MEYER, the cancer immunotherapy company, just had some fantastic results out in lung cancer. Small market cap of $250 million US. The drugs they're developing, once again, billions of dollars. The interesting thing, I think, in the large cap pharmaceutical space is that there's huge patent cliffs coming up for these pharmaceutical companies. The largest immunotherapy drug in the world is Keytruda, sells $20 billion US a year with patents expiring in 2028. So these companies really need to go out and hoover up all these companies like MEYER and OPTHEA if they're to sustain their earnings over time. So, you can never say when a company's going to get taken over or if, but I think both are very well positioned over the next couple of years.
So just to confirm, Tenet, that's a holding in your portfolio as well?
That's right, yes.
Okay, so the themes with Blue Sky that you're referring to are hospitals and sort of biotech and pharma, or the smaller end.
That's right. Tenet is a $4.5 billion company, so it is larger, but still we think very substantial upside potential. It's got $15 billion of debt, but it's generating $1 billion a year of free cash flow. In addition, it pays $800 million of interest, so $1.8 billion of sort of free cash flow before interest. So, over time, that's a lot of cash flow that it can just generate to pay down that debt. And then, if in 10 years' time, you're left with a very lowly geared company with a $5 billion market cap generating, $1.5 billion of free cash flow, then it's clearly not going to be worth $5 billion. So, I think that could re-rate very substantially.
Makes sense. Now, the last question that we got actually came in quite early, but I thought it made sense to leave it towards the end. And the person says, sorry if this was already mentioned, but what is your overall outlook for the fund over the next 12 months on a macroeconomic basis?
Yeah, I mean, it's trying to predict, performance is obviously very, very difficult. As I sort of went through, there's a lot of stock-specific things that could go right for the fund over the next 12 months. TELIX keeps delivering, I think, is the largest holding. But from a macro point of view, I think we discussed interest rates initially in that first slide and inflation. So I think that will continue to have a huge impact on the market. If inflation comes down, the US Federal Reserve stops raising interest rates, I think the market is looking, very attractive. And it does seem like there's a lot of indicators that are pointing towards that. Everything from commodity prices falling, supply chains easing, labour market. I saw Amazon's cutting 10,000 staff today. Lots of layoffs beginning to happen, which is unfortunately a necessary part of bringing inflation back down. And we have to get through the earnings downgrades for some more companies. So I do think you need to be a bit careful about which companies you are in over the next 6 or 12 months as they lower their earnings. But things like healthcare, obviously quite immune to that. So I think we're reasonably positioned. Europe and the Ukraine, what happens there will obviously be another unknown wild card. Just whether that comes to an end, that would be hugely positive for Europe if a peace accord could be found. I'm not suggesting that's likely, but that would be really huge upside for Europe. But if Putin does something crazy, then obviously a bit of downside risk, I guess.
So basically, if my interpretation is a more benign macroeconomic environment will provide a tailwind, a general tailwind, but the real returns are going to be idiosyncratic stock specific. And to your point earlier on, the stock market tends to start to rebound 6 to 12 months before we see the economy picking up as well.
Absolutely, yeah. So timing that will be important.
Great. So thanks to everyone for joining us this morning, and thanks for all of those who submitted questions. I think we've answered all of them. If we didn't get to yours or a version of yours, please get in touch. Our next webinar in the series is next Tuesday, the 22nd at 9 a.m. With Ted and Claire from the Pengana Web Sustainable Impact Fund. You can register for this webinar on our website, pengana.com. If you have any other questions, please get in touch. We'd love to hear from you. Thanks for joining us and enjoy your day.